The best traders don't chase trades. They make sure they understand market context first, and then they strike when the iron's hot. Trading isn't about always being in trades. It's about finding good trades, which is the easy part, but the hard part, avoiding the bad trades in between that sink the ship. So in today's video, what we're going to be doing is we're going to be breaking down part 2 of developing a trading strategy, how I've developed mine, and I'll give you the formula that goes into every successful trading strategy. That doesn't necessarily have to be the exact way that I trade, but I'm going to be showing you how I develop the understanding of not only market context, but also trade setups and understanding the full length of a strategy before we run into video number 3, which is coming out after this. But in order to do that, we have to jump into the screens and take a look at some of the charts as I blab. So I'll see you guys on the other side. Make sure you hit that like button, that subscribe button, and let's get on with this. So now that we're back on the screens, we have something that should be extremely familiar to anyone at this channel or that's seen this channel. And what we're going to be doing is breaking down bits and pieces of this. But first and foremost, we're going to be talking about what really a trader would need to develop a trading strategy, a profitable trading system, something that is rule-based and has consistency that can be repeatable, right? Repeatability is the key to success. It's not having a 100% win rate. It's not having only good trades. It's avoiding bad ones and being able to constantly follow your rules. So the first thing that we need to understand is market context. Market context is going to be everything. What is market context? Market context refers to the overall environment or condition of the market that gives meaning to current price action. It helps traders understand what type of market they're in, who's in control, how price is behaving relative to value, right? And it's very important because this ties in everything realistically. It ties in the concept of where strategy comes from. Because if you're looking at the market and you're just reacting based on moves, you're essentially starting to chase, and you're starting to chase ideas, you're starting to chase movement, and you could be getting long, short, one after the other without any kind of reasoning to it. So if you understand market context, you're developing the first aspect of being able to devise some kind of trading plan, system, whatever it is. And market context can take many different shapes and forms, right? It can come from a multitude of different things. Now, how have I developed the understanding of market context, right? There are several different paths, but what I have generally done is gone from piece to piece to piece until I finally found auction market theory. So market context, it can theoretically be developed using any different tools. There are traders that use solely price action. There are traders that use candlesticks. There are traders that may use moving averages to develop their market context and their understanding of how market works. But the main tool that I have come across that's really helped me understand who's in control based on the understanding of market participants is going to be based on auction market theory. So I've used price action in the past. I've used many different tools, but I've just dived into auction market theory and started using volume profiles to get a better understanding of what context looks like. So when we talk about auction market theory, again, a quick little breakdown from last video as well. Markets, they move in two-way auctions, right? There's buyers and sellers that come together to create what we call fair value and unfair value. When buyers and sellers meet at certain prices, they start to develop what fair value is, and they start stacking volume over and over and over again to create balances. So from a visual component, a very basic overview, markets generally tend to move based on areas of balance and imbalance, right? Based on compressions and expansions. If we have a multitude of different balances, what we're going to see is that prices find their way through them, right? In these areas of balances, this is the fair value that market participants are generally looking at prices as being equal. This is where the volume profile comes into play. So a volume profile is going to be the basis of, right, the understanding of fair value. Fair value is going to be in the balance area and unfair values are going to be in the extremes. Market participants are the ones that move the market. Strong-handed market participants to be exact. Strong-handed market participants can be identified as almost any type of trader, but generally we start to look at them as institutional type traders. They're the ones that move markets in terms of large expansions and keep markets in the contraction period. So they get active at areas where volume drops off because they're able to identify an easier path to get to where they want from those areas. So it's going to be very easy for a very large size mover to get into an area where a high volume node starts to meet a low volume node before the volume completely drops off. And that's how market participants get active at key ledges, and they create those key ledges. So they'll create kind of a balance and fair value area that creates a compressive period. And when information might come in and there's more selling than buying, prices will go down. Continue this kind of balance, they'll go back down. Continue this kind of balance, maybe they go back up, right? And generally our goal is to identify where all these balances are so that we can understand what the context and what the directionality of the market is. Because if we keep moving into balances lower, contextually speaking, we do have bearish context. We have more of a bearish inclination in the market, and there's clearly more selling than buying at those times. So you want to always be thinking contextually, where do heavy-handed market participants deem fair value? And that's going to be reflective in volume profiles, right? What clearly can show this imagery that I've drawn on the screen here to give us a better understanding of price levels is going to be the volume profile. So when I started learning about volume profile, when I started learning about auction market theory, I started to learn about two different types of volume profiles. At the beginning, right, my learning path on volume profiles was the general basics. Value area, point of control, value area high, low, right? Very basic things. But the more you start to understand auction market theory, the more you start to understand how market participants actually behave, you start to look at it from a very different perspective. I started looking at it from the perspective of composite profiles. A composite profile is a profile that adds several sessions together. Whether it's 5, 10, 2, even 100, 300, it's going to give you a better understanding of where the cumulative volume blocks are going to be located on a very specific length of time. Now, I can use both the individual days as well as the composite profiles, and you can create a lot of different types of composites of profiles, whether it's a 5-day, a 50-day, a 200-day, and start comparing them. Now, the power of composite profiles is the understanding of where there was an accumulation of volume to create balance in the most recent past, right? In the very distant past, where market participants have been active at prior areas, and where they're currently getting active over the current few sessions. So, does it really matter which size of composite profile you select and pick? Not necessarily. They all generally show context in the same way. So if I can look at what's going on right now on the S&P 500, this is a general larger balance with some kind of drop off here. So this is the 400-day composite profile right here on the right-hand side. You've seen this a lot. This is the 5-day composite profile that's showing a very similar balance into this area. So contextually speaking, when I look at this, if I see that there's another massive balance of fair value that has been created at a lower price and the market has printed higher into this new or this higher balance with several closes, then I can look at this from a contextual understanding and think, okay, well, the S&P is fairly bullish as long as we can hold within the balance that we've run into, meaning this high balance, as long as we can hold 620 to 6225 into this bottom band low, then I can look at it from the perspective of I still want to be bullish, right? I still want to be bullish until maybe I see failures at the top of the balance. I can use this composite profile to give me maybe a little more information as to where maybe some more precise areas might be, but contextually speaking, I'm still looking at the buy side. When I look at context from this perspective, I want to understand where we are in relation to these big balances, where those big balances are naturally, and how prices have moved into them, right? Because this generates an idea of market participant activity. So what I mean is, I want to look at session closes. If sessions manage to close in new balances higher, then I want to be bullish and I want to be looking to buy dips. If sessions manage to close within balances lower, well, I want to look at a more bearish context of things. So I can use individual profiles as well as composite profiles to get the levels that I want to trade based on the key extremes, but I can really understand who's in control. Another quick tip about understanding who's in control is finding where excess moves have been created through these balances. So if there's an excess move to the downside or the upside and prices close back within that balance, prices want to maintain fair value. So if I see an excess below and we close back within the major balance, I'm still going to have bullish context because we've failed to really move away from the majority of the volume. and we've closed back within telling me that all of that selling was just very weak-handed and non-aggressive selling that failed to really contribute to any downside momentum. It's the same as this excess move at this top. So the development of context, right, whether you're looking at it from this perspective or a different perspective, is an increasingly important tool to being able to develop a trading strategy. Some traders might look at it from a price action perspective. Some traders might look at it from individual profiles. Whatever the case is, my point is that you always want to understand who's in control in the market and where they continue holding control and where they lose control so that you can understand how things shift, right? How would things shift? Well, I'd look a little more bearish if we actually start accepting balances to the downside, which is a very far ways away. I'd remain bullish if we manage to continue the acceptance higher. So I still want to look at this from a bullish perspective until things change on a day-to-day basis. So after we have the breakdown of context, we understand who's in control, the market participants, who's on the right side of things, right? Bullish, bearish, where we are in terms of distributions. I can split up the 3 trade setups within the system into 3 specific archetype categories. They're the classics. Number 1 is going to be a pullback trend. So a pullback trade is a trend following tool. Whether we're bullish or bearish, I'm looking to follow the current momentum of the trend on pullbacks into that momentum. So if I have a bullish trend, I'm looking for a higher highs and higher lows, and I'm looking for an area where I can be a buyer to continue the momentum that's being presented. So I want to go with the trend. The second one is going to be a fade. This is counter trend or called mean reversion, where prices expand very, very far up or down, and it looks like they just can't do it anymore. Generally speaking, I look at this from a perspective of where distributions are. So if we have a distribution like this, I'm only going to be counter trend trading at the tops and the bottoms, or if we get an expansion too far away that tries to revert back in. Meaning, if we have a bullish trend, I'd be looking at where the bullish side starts to fail, and I can start looking for that turning point back down. Generally, these fades, if we have a resistance top here based on whatever kind of context resistance you may find, I like to look at it from the perspective of a move that creates an excess and starts failing back within that resistance to create these lower highs from that bullish perspective into a bearish move. And the third archetype is going to be breakout trending, which is trend following. So if we have a resistance here, the breakout trend happens above when buyers really create that excess to continue the move. Now, each of these archetypes are presented based on specific market conditions. So I don't think personally that every single market condition presents this kind of trade, all 3 of them at once, right? And they also adhere to certain traders. For instance, I do think it's rare that there's a trader that may trade all 3 of these as they appear at any time, right? I don't necessarily think that most traders are very willy-nilly about the setups that they choose based on these 3 archetypes. Generally, traders have strengths and weaknesses in the trade setups, and some types of trades may resonate better with others than the other 3 or the other 2. For instance, I only trade pullbacks and mean reversion. So number 1 and number 2. Those are going to be the main types of trades that I trade. I don't trade breakouts because they don't resonate with me. I've never been good at them, and I've had a very low success rate. I would rather be on the start of a move, whether it's a pullback move or a mean reversion move, and use a slightly wider stop to protect myself, than try to anticipate where it's going to actually expand or start the clean expansion. So my 2 trade setups are going to be based on auction market theory and order flow. The context defines the type of trade setup based on the volume profile. So the context is going to give me that first clue of what kind of trade based on 1 or 2 I'm going to be taking. So if I identify a trend as bullish, and we've made a move through a balance. So for instance, if we have a bullish move and we've started moving through a balance top, right, and we're trying to accept through this balance top, I would be much more inclined to look for pullbacks to continue this momentum, or if we accept into a new balance, to look for pullbacks to continue the momentum. In this case here, let's move this up a little. So if we have this distribution over here, and we either accept into it from below, I'd be more inclined to buy dips, or we leave it from above, I'd be more inclined to buy dips because the momentum is very bullish than me trying to identify, boom, this is the breakout, boom, this is the breakout, because the way that I've experienced it before, there's often head fakes that get me trapped. And instead of me being on the head fake getting trapped on the breakout, I'm looking for that mean reversion or something that I call failed acceptance, which is the second type of trade, which is a fade. It's counter trend, it's a mean reversion trade. Because if we get a move that fails and comes back down, it resonates a lot more with me if we're creating lower highs that I find the failure of that move so we can move back down counter trend, opposing the current momentum that has created that upside move. So whether it's to the downside or upside, I'm looking for some of these trends. I'm going to show you two examples of when we used both of these realistically to identify some kind of trend momentum movement. I'm going to use NASDAQ for this purpose to find both a counter trend move as well as a trend side move that all happen in one day. So if we take a look at the NASDAQ here, right? The NASDAQ on the day session itself, if we're looking at context, what I have in front of me here is I have this area that develops this key distribution extreme that splits things up. We've got another area down here, and then we've got a very big area down here. So this last area I drew can be seen as maybe the bottom band of this larger distribution. So realistically, if I'm above these areas, if I'm trading somewhere up here, and I'm looking at the individual day sessions, and I see, okay, there's low volume trying to hold here, there's a low volume drop off and very, very heavy volume into this low. So we're above this support structure zone, meaning contextually speaking, I am a little bullish, right? Even though there are some failures at the top, I think that maybe we can see if we can get that push higher. Right? If we can get that push higher, I want to remain bullish, and I fail to be bullish if we move back under this area. So anything back under this area starts to move into a distribution lower, which would tell me contextually speaking, I'm probably better off looking for sells, meaning that any trade I take long down into these areas is going to be considered a fade, right? Or a mean reversion type move. So if I'm looking at it from that perspective, from context, the first trade that I take right here is in the direction or pullback into this area over here over the last several days, right? So I'm just trying to go with the trend to see if we can make a move above. Based on the auctions, the potential of this trend is only up into here, prior overnight POC and the drop off in volume in 840, right? So that's exactly where we got into and things really, really hit the fan. So if I'm trading under the level that I got long at, which is around 785, I'm going counter trend because things have shifted. We moved into distributions lower and I'm going against the momentum that's clearly coming through. So if I get long over here, it works for about 35 points and I take a stop. It's counter trend. Counter trend trades generally have a lower probability of working out, but when they do, it's going to be something drastic. Then we notice that there's a buildup of passive buying and traders trapped right around the 590 area at the bottom band of this distribution. We take our shot and it works out for about 140 points. So this is a counter trend move, higher risk. I took a stop while trying to fish out this fade, but in essence it worked. Where would the pullback be? If I change structural context, if I lose this area, because I always want to know where the line in the sand is for me to actually lose the current momentum and find different directional context. Meaning if I'm bullish to begin with, I really need to know where context shifts. So if I'm trying to buy, I'm very aware that it's a fade and the probability is dropped off. But if I lose that 780, if I pull back into it, then realistically, that's going to be the pullback to continue this trend based on the context shift. So I didn't necessarily want to overcomplicate these things, but these are good examples as to which archetype you might be more inclined to look for, because I think it's very important to be able to differentiate that as you're developing your strategy. So I have both those archetypes in my repertoire, and I'm mainly only looking at those based on the context of the auctions. So the third part is strategy execution blueprint. Developing a strategy and a system or either or means having rules in place and set up so that you can execute each of your setups as they appear when those conditions are met. The most basic definitions you should have in terms of developing your system, in terms of being able to execute and create that formula, is number one, context into a trade setup. Number two, confirmation. Number three, the trigger. Number four, risk and risk management. Number five, trade management and exit plan. The ideal scenario is that you have all of this thought out and drawn out before you actually enter the trade. So let's run through an example based on the information and strategy that I use to trade. So number one, context into a trade setup, right? So what I'm looking for is the volume profile to dictate the direction and momentum of the trade. So if I have context and I'm trying to break down this current trade, the idea was based on us being outside of this major distribution, seeing multiple session closes, seeing overnight heaviness of volume, and seeing volume drop off into that big composite area. So I'm thinking, well, around 780, 790, I have a contextual bullish momentum move that would target 840, and anything above is really going to pull this through. So I'm wrong if 780 breaks aggressively, and at that point, anything under is counter trend and I should be looking for the sell. So number two, if I'm looking for confirmation, I'd be looking at both a volume profile to understand where the exact level is and order flow. So order flow takes two shapes. The confirmation that I begin with is the creation of delta accumulation to absorb into an area. Meaning I'm looking for negative delta absorption into a support zone to be able to identify if there's passive buying, right? Number three is the trigger. The trigger is based on order flow as well. The trigger can be based on the depth of market or the footprint, where I want to enter based on this information. So if I take a look at the footprint, because it's an easier visual tool and component, I'm going to be looking for passive buying on NASDAQ, meaning very heavy negative delta that tries to hold bid. So you can see over here, we start the bidding from this passive buyer trap seller that makes the push. I know in this area, if I see more of these guys holding bid, then I can get in at that negative delta volume profile. So we pull the trigger, it goes up about 50 points in my direction. The rest of it got stopped out at break even before we get a very big structural shift. At that point, I know that realistically, I'm going to be fading if I'm buying anything below these areas, right? It's the same construct. I have a good area over here, 680 based on the volume profile. I have negative delta stacking up. I have a lot of this passive buying and trap shorts that get rebid. Why not take the shot? It moves up about 35 points in my direction. I take the full stop without managing it. So even if I'm wrong, I'm still right at a certain amount of time so that I can make a decision. Same thing down here. Massive traders, right, coming in. They're pulling prices down. If we can get above them, they should bid. Even better yet, huge traders get imbalanced, rotations into the lows, continuation, big negative delta block, confirmation, trigger, get long, bid. If I waited for this confirmation, I could have maybe had a better and safer trigger without my heart palpitating as much. Number four, risk and risk management. So the way that I look at risk and risk management is that I have a flat stop. So generally on NASDAQ, I use 20 to 25 points. Some traders might want to think about this. Where is your stop in relation to the trade entry, right? You always want to understand that. You always want to look at two things. Is my stop protected? And what's the logical potential of the trade? Not what you want, but where could this trade possibly go so that you can look for an exit plan, right? If I have a 2-to-1 R to R based on the potential and based on my 20-point stop, I'll take the trade. If not, I really got to think about it. So when I talk about that and the potential of trade, I'm looking at an exit plan. So that's number 5, trade management and exit plan. So they tie together. The potential of trade, the way I look at it, is where is there a next distribution extreme? Where is there negative delta? Where have order flow sellers come in from before? So that's the general potential. If I look at this trade, my potential is between 50 and 60 points. If I'm taking a 20-point stop, it's worth it. So the last part is trade management, right? Trade management and exit plan. What is my target on the move? Again, is it based on price action? Is it based on auction extremes? Is it based on order flow? Is it based on all of them? That's going to dictate if I want to take the trade or not based on the R to R. So how will I exit? Am I going to partially exit, or do I have a full exit strategy? Now, I personally prefer partial exits because I can be a bit more malleable with the position sizing. Some traders prefer just full exits, which is fine, but they have to have a very defined understanding of their exit plan. So my general exit plan was into 680 on this fade from this bottom. So if I have a 20-point stop and I have the potential of an 80-point take profit, I'll take it. My first exit was at 50, 55 points because of all of this delta that was accumulated there. And then whatever runners, little two runners, they can go and do whatever they want. So these 5 things are pivotal that you need to understand. Context, confirmation, trigger, risk and risk management, and finally trade management and exit plan. Every single system needs to have an understanding of that before you go anywhere realistically. Now the last part of this, before we wrap up the video, is giving you a bit of a breakdown and understanding of some of the most notorious futures trading strategies. You've heard of many trading systems out there, right? Based on price action, moving averages, order flow only, maybe auction market theory, even ICT. The thing is, and my point is, there's no one right answer, right? It depends on the trader and their ability to take in information that resonates with them. Sometimes traders might not understand order flow, but they understand auction market theory or price action. That's why I trade based on auction market theory and volume profile, because it's the most logical for me. Volume is what moves price. Auction market theory explains market participant behavior, and it all ties together to understand how the market moves in a two-way auction, how heavy-handed market participants move price, and how it's visualized in order flow and volume profile movement. So maybe this isn't what exactly resonates with a specific trader, but that's a huge, huge aspect that you have to understand when developing your trading system or trading plan. You shouldn't only develop a trading system because XYZ trader you like trades that way, or XYZ trader says they make XYZ profit and you're like, wow, that's amazing, I gotta trade like that. It's something that needs to make sense with you because there's 1,000 ways to skin the cat. So now that you've got the building blocks of part 2, understanding context to build out steps and execution, you're gonna want to wait for the final part, which is gonna come out soon. So we're gonna be talking about how to evolve your strategy and your trading to develop more confidence and development of the system itself as a trader. But before that, you're gonna want to get a free PDF in the link below. It's in the description. It's a guide to help you understand these concepts that we talked about a little more and work on the 3 things that may be holding you back as a trader. So if you thoroughly enjoyed this video, give it a thumbs up, hit that subscribe button, and get ready for part 3 because we're gonna be doing more examples and breaking down even further steps to help your evolution as a trader in the development of your trading system. Thank you and bye-bye.